Hello, welcome to Be the Boss of Your Money. My name is Mitch Goldberg. I'd like to welcome you to another live episode. Why is the stock market going higher if the economy is in such bad shape? That's the question that I receive the most from people. Why is the economy going higher when the economy is in such bad shape and unemployment is so high? How could the stock market go up? That's what we're going to talk about. I'm going to explain this to you in a very clear cut way, and you'll know. So let's roll the intro and we're going to get right into the content. Hello and welcome to another live episode of Be the Boss of Your Money. I named this live stream Be the Boss of Your Money because I want you to be the boss of your money, not your money to be the boss of you. My name is Mitch Goldberg. I'm a financial advisor with Client First Strategy. Today's episode is all about answering the question, how could the stock market do so well when the economy is doing so poorly? First, I want to say that the stock market, while being down, it's only down a little, and it certainly does not reflect the current state of the U.S. and, in fact, of the global economy. We're going to talk about that. I want to give you the answer, explain to you why why the stock market and the economy are not always tied at the hip. And as a matter of fact, they rarely are. So I'd like to welcome you. If you're watching this in the live stream, I would welcome your questions. Please ask away in the comments, and I will be sure to get to you. If you're watching this in the replay, I'd like to welcome you as well. If you're a watcher, a viewer of this live stream, you know we always start with a little bit of perspective, what happened in the market. So a quick update. So first thing we're going to do is we are going to talk about the stock market and give you a quick rundown with a share screen. First thing first, as you can see, the Dow is up over 500 points. Last Monday, the Dow was up over 900 points. So another really good, solid performance in the markets for a Monday. S&P up 36, NASDAQ up only 15. There's a reason why the NASDAQ was up only 0.17%. when the other major averages were up anywhere from 1.23% to almost 3%. The VIX has come off just a little bit, and that's something we want to see. We want to see the VIX go down. So let's take a look at some of the news today. The big thing to me, if you can see this chart on your small smartphone screen, the S&P 500 briefly broke above its 200 moving day average. That's significant. That indicates that there's been a lot of repair work done for the market. Investors have gotten past their worst of their fear-based selling, and it tells you that stocks are being accumulated again. It also tells you that what I think could happen next is something called what I call a performance chase. So stocks, as you can see, are not down all too much this year. People have maybe bailed out of stocks too heavily, especially professional money managers, hedge funds, mutual funds, etc. Now that the stock market is recovering and indicating signs of strength, what I say is that the performance chase is on. So fund managers, they have to now jump back into stocks, show their shareholders that they in fact own stocks, and typically what they'll do is they'll buy the best performing stocks, especially on any pullback. So this is a very bullish indicator. Now, the S&P didn't close above that moving average, which we would have liked to have seen, but it did climb above it and finish just about at that mark. No matter how you slice it, it's a bullish sign to me. And if I told you that this could have happened a month and a half, 2 months ago, you probably would have had serious doubts about that. So let's move on. Big gainers of the day: United Airlines, Norwegian Cruise Lines, Royal Caribbean. You see these stocks up double digits today. Delta up 13%, Alaska Air. Southwest Airlines, Carnival Cruise. You could tell that the stocks, in particular airlines and cruises, were the best performers today. So that's a really big catch-up trade. Some of the losers are some of these stay-at-home stocks like Take-Two Interactive, Activision, so NVIDIA. So these are some of the biggest stocks as of late. And let's keep going. And we're going to get through this because we have some important things to talk about. Let's take a look at the FANG stocks, the FANG plus M. And the reason I said before is the NASDAQ was barely up today. Now you'll know why. Facebook was down over 1%. Apple is off a touch. Amazon off a little. Netflix off over 3%. Google up a tiny bit. And Microsoft 1%. The bottom line is overall, the big 6 stocks, FANG M. So that's Facebook, Amazon, Alphabet, Netflix, okay, Microsoft. These stocks did not have a particularly good day. Not an awful day. They just backed off a little bit, but they're so big. They represent such a big part of the S&P 500 that when they don't do well, it's really hard for the rest of the averages to do well. And since they're an even bigger part of the NASDAQ, you could see why the NASDAQ was barely up today in spite of it overall being a good day. Let's move on. Let's take a look at some of the other Corona stocks, the coronavirus stocks. Zoom off over 7. Hey, look, it's had a huge run, so being down is could be forgiven. Clorox remaining under the $200 mark. Activision we spoke about a second ago. Peloton down 4. Domino's Pizza down 12. Campbell's Soup down 99 cents. These are the stay-at-home stocks. Put in a poor showing. So you see what happened here today. The industrial stocks, the companies that are economically sensitive, have really put in a good show. And this is what I always say to you. Today was a V-shaped day. Every day I like to say what shape of the day, what letter shape can we put to the day. So today was V-shaped, meaning you had a steep down economy, down market. Today, investors are excited about a steep recovery and a steep up market. And you can tell by the way the sector's traded. When financials, the XLF, I'm using these major, very popular exchange traded funds from Spiders to give you this view, but these are the ETFs that I follow every day. XLF, Industrials, XLI, XLE Energy, this is real estate. But when you see XLF, XLI, and XLE lead the way up, those are really the most economically sensitive type of stocks. And when they have a good day, that is generally speaking a very bullish sign for the economy in terms of expectations. And at the bottom were healthcare, tech, as you saw with those big tech names that we just went over, communications, consumer staples. So in spite of it being a great day, communications and staples, healthcare didn't have a particularly great showing. If you just looked at these 4 sectors, you'd probably think it wasn't such a great day in the market. But then you'll look at these sectors, financials. When financials lead, that's very bullish. And stocks like Citigroup, Bank of America, JP Morgan, these stocks are up 7 or 8% across the board. So very, very bullish day as far as expectations go for the future of the economy and the stock market. And lastly, just here's that chart we just went over again, just that 200 moving day average. So you see 34% downdraft from peak to trough. And now we've recovered probably about 55, maybe 60, 62% or so of the bear market. And you know what? Things are not looking so terrible at the moment. So if people who had an investment strategy and who just hung in there and you were invested appropriately, you've gotten through this pretty good. Hopefully you didn't panic sell or say, I need to sell at the bottom. I'm not saying it's a bad thing to recalibrate, saying maybe you got into risk assets a little over your skis and you needed to pull back a little bit as the market was recovering. I'm not saying there's anything wrong with that. It's all an individual, personalized decision. But for the people who decided to bail out of everything or mostly everything and say, oh, I'll get back in when things go lower. Well, things did go lower. You missed the whole move. And now you're probably kicking yourself. And this is why I don't condone all or nothing decisions. Okay. And let's just take a quick look over here. One more thing to show you them. I'm going to stop the screen share Problem is when you live stream, the computer does go a little slower than you want it to. Let's see if we could just get this going here. Okay, year to date, S&P is off about 7.4%. That's all I wanted to show you. Okay, so we're going to stop the share screen. So year to date, S&P off 7.4%. Nothing overly terrible. I hope I didn't just kick out the mic. Okay, so we are looking good. So the question of the day is this: how could the stock market be doing well when you have something akin to between a Great Depression and a horrendous recession? You have closed economies, social distancing. People ask me all the time, why is the stock market up? What's going on here? And obviously there's a disconnect, and the stock market has to go down rather, because there's no way that this could last. Well, let me just explain a few things to you. And I think I'll put this in perspective and help you become a better investor. So there's a few things to unpack here, and I think I could do it in just a matter of minutes. So we're talking about the S&P 500 in particular, which is an index, a very popular, probably the most popular stock index in the world. You cannot invest directly into an index, but you certainly may invest in a security that tracks or mimics an index. So let's start by saying this. The stock market is actually doing exactly what it's supposed to be doing. And that's the thing that I want to convey to you. And now you could retort, you could ask, that doesn't make sense. The economy stinks. Almost 40 million people lost their jobs. How could the stock market go up? And there's something wrong. It's rigged, or there's some crazy reason why the stock market is not down with the economy. Well, that's because you may not know the stock market as well as you know the economy. So just want to say this. When I say the stock market is doing exactly what it's supposed to do, anyone who wanted to sell has been able to sell. Anybody who wanted to buy a stock has been able to buy. The market has functioned. Even with the closing of the New York Stock Exchange, the stock market has continued to function very, very well in that regard. In other words, giving you liquidity, giving investors the ability to buy and sell securities, trade securities with one another. So that's one thing. Mechanically, the stock market did just fine, but it's up too much compared to what the economy is doing. The way the mechanics of the market work is it's a market cap weighted index. So the biggest companies have a much greater influence on the stock market, on the S&P 500, than the smaller companies. So if you take a look, okay, I think this calls for a share screen. If you take a look at the biggest companies in the index, and I don't know if you could, how clearly you can see this. I'll see if I could blow this up a bit more. Okay. So if you take a look, there's Microsoft, Apple, Amazon, Facebook. Alphabet is in there twice because there's two classes of Alphabet stock: Johnson & Johnson, Berkshire Hathaway, Visa, Procter & Gamble. If you take a look at the biggest companies in the S&P 500, they represent about 28% of the average. So when Microsoft, Facebook, Amazon, Alphabet, when they do well, it has a tendency to drive the rest of the stock market. So it's kind of like the expression, the tail wagging the dog. But in this case, it's a really big tail. The tail is proportionately very big compared to the size of the dog. So that's what I mean by the tail wagging the dog. So that's one thing. And then you have the situation that we're in. So COVID-19, coronavirus. The way this works is that the COVID-19 has created winners and losers. And when you have winners and losers, it means who could do well in this environment and who can't do well in this environment. And then you have the policy response. The Federal Reserve lowered interest rates, pumped trillions of dollars into the economy. We had the CARES Act. We have maybe another stimulus act coming from Congress. So we have a lot of stimulus. All of these things have a tendency to create winners and losers. So if you think about who the winners are in a stay-at-home economy, it's favored tremendously technology, companies that allow you to work from home, companies that allow you to work in the cloud. Okay, so that's part one for that little part. Let's say part two is that when I say the stock market is doing what it should have done, is if you look at the stock market, there are definitely signs of a massive recession and even a depression. So if you take a look at some of the biggest losers, like Carnival Cruise, from its high, it was at 1.53 and change. It closed today at 16, in spite of a good day, down 70%. United Airlines, $96 is the all 52-week high, closed today at 29.53. In spite of a really good day today, it's still down 70% from its high. If you look at the XLE, that's the ETF that tracks the energy sector. That's down 36%. If you look at XLF, that tracks the financial sector, the ETF that tracks financials, which has companies like JP Morgan, Bank of America, Citigroup, Wells Fargo. That's down about a third. And even utilities have lost about 15%. Stayed safe, steady utilities that pay dividends has gone from 71 at its 52-week high to 56. So that's a pretty sizable drop in a sector that typically you would think would hold up well in a recession, and also add to it very low interest rates. It would make dividends even more attractive. So if you take a look at that, the stock market, the situation we're in, the policy response, the state lockdowns in terms of the economy, this has all created winners and losers. There's consequences to everything, and everything touches everything else. Everything is connected. It's like it's a food chain, but it's circular. So that's why you can have a stock market, albeit down a little bit on the year, maybe down 9% or so, 10% from its all-time high at most. And yet the economy has plunged much more than that in terms of GDP. And we talked about how the unemployment rate is skyrocketed and the number of jobs losses close to 40 million. But you have to understand the mechanics of the market and why the market does what it does, that the stocks that are the winners because of the current situation are also the biggest companies. So they're the tail that wags the dog. And if you take a look at other sectors, clearly the stock market does reflect a severe recession or depression based on how airlines and energy and a lot of individual stocks have performed. I think it's a good thing that we have winners and losers. And I'll tell you why, and I'll wrap it up with this, and then I'll get to your questions. It's a good thing that we have winners and losers because it shows you that it's not just all about the S&P 500 wagging the whole market, controlling the whole market. It's not just a risk-on environment or a risk-off environment, but investors have been able to discern between winners and losers. And that is what I mean by saying the stock market is doing exactly what it should be doing. It's capitalism. It's winners and losers, and every situation has consequences. Now, I'd like to take a look at your questions and see who's out there. Bill, good to see you after a long weekend also. Plus, I took off Friday from the stream. I'll be taking off. I won't be doing the live stream on Fridays probably until October, but I'll be here Monday, Tuesday, Wednesday, and Thursday. I'll do this on a Friday for sure if something really big happens and something that's truly newsworthy. So it's good to see you, Bill. And it's good to see you, Filippo. V-shaped recovery, always be buying. Let's go, Mitch. Thank you, buddy, for the shout out. It is there are a lot of bullish indicators now that the economy is opening up. You've got another vaccine in the works. Some strategists are saying the reopening of the economy is going a little smoother. If you recall, if you're a watcher of the show, I've been saying that we could see the economy open up much quicker than expectations. We could see people get back to work and get back to spending pretty quickly. It might not be fully what it was, but we could see a lot of it come back pretty quickly. And with that, I would like to, we have a question here. Bill asks, how do you think the market will do with the loss of Chinese stocks? I don't think the market will even notice it. I think the stock market will just run right over that. As far as Chinese stocks go, it's not just an automatic delisting of all Chinese stocks. They have to meet certain requirements and accounting standards. They may be given time to do that. They may have to prove that they do that. So I think investors will have plenty of time to adjust to that possibility. But regardless, even if they have no time to adjust to that possibility, I don't think the stock market misses a beat. I think it has almost no impact. The moving average looking good today. It sure is. So let's see what happens the next couple of days. We might sink a little bit from the moving average. It doesn't mean all bets are off. It just means, think of it this way: the market has to re-energize, recharge, reload, and then fire again. So it's a short week. We only have 3 more trading days left for the week, and then we'll know a lot more by the time we get to Saturday. So thank you so much all for watching. I'm going to end this broadcast. If you think of anything you'd like to ask, keep asking away. I'll be checking the comments for the rest of the evening. Thank you very much.